I'm Alex. I hold about 70% of my portfolio in US stocks. If you're new here, welcome. I analyze the US stock market from a Canadian perspective, focusing on what Canadian investors care about most. No hype, just practical steps to navigate Fed moves, tariffs, and market dips. So here's the honest part. I checked my portfolio recently and yeah, I was pissed at myself. Not because I didn't own US stocks. I did and I had them. The problem was my positioning. I was way too cautious when it actually mattered. And I know a lot of you are in the exact same spot. You've got US exposure, but it's what, 20, maybe 30%? It's there, but it's small. Or you stuck to the safe ETFs, VFV, VOO, nothing wrong with that, but you never had the conviction to size up into the real leaders. And maybe the biggest one, you knew the US market was stronger. You just kept waiting for the pullback, waiting for the perfect entry, waiting for some signal that never really came. And while you were waiting, the market just kept moving without you. That's the regret most Canadian investors actually feel. It's not about not investing in the US, it's about not having the confidence to lean in when the odds were already in your favor. Today, I'm going to break down exactly how I'm allocating my ETFs for US market exposure as a Canadian investor. And I'm not going to bore you with theory or textbook crap. This is literally what I'm doing right now with my own money, the mistakes I made and how I'm fixing them. Plus, I'll show you the tax tricks that honestly should be illegal, but they're not. So we're going to use them. All right, let's dive in. Now, let's be real. The TSX is tiny compared to the US market. The entire Canadian stock market is only about 3% of the global market cap. That's insane when you think about it. And over the past decade, the S&P 500 has absolutely destroyed the TSX in terms of returns. I'm talking roughly 13% per year versus like 6% for Canadian stocks. That's literally more than double the returns, guys. But here's the subtle mistake a lot of Canadians make. And I was guilty of this too. On paper, it looks like we're diversified. 70-80% of our money is sitting in TFSA and RRSPs. And yeah, inside those accounts, we hold these things like VFV or XUU. So technically, we do own US stocks, but mentally, we still treat it as a Canadian portfolio with a bit of US flavor on the top. It's passive, US exposure, not a deliberate decision to let the US market drive our returns. That was me for years. I told myself I was invested in the US, but I never sized it like I actually believed in it. I kept my allocations small, avoided going heavier when the trend was obvious, and hid behind the comfort of doing what everyone else was doing. Then I finally sat down and ran the numbers on what the hesitation was costing me. Not because I picked the wrong ETFs, but because I never let my US exposure do the real heavy lifting. Over just a few years, that gap added up to real money, the kind that actually changes your long-term outcome. And yeah, that realization stung. So I didn't blow up my strategy and start from zero. What I changed was how intentional I was with it. I stopped treating US exposure as a side dish inside a Canadian framework and started building my portfolio around it on purpose. That meant being clear about my allocations, being honest about what was actually driving returns, and having the conviction to size things properly instead of hiding behind vague diversification. So now let me walk you through how I actually structure my portfolio. I'll give you the exact percentages I use, but more importantly, I'll explain why they're set up that way. Because at the end of the day, the numbers matter, but the thinking behind them matters even more. First up, 60% of my portfolio goes into the US total market ETFs. This is my foundation, my core holding, the boring stuff that I basically never touch. I use VTI, the Vanguard Total Stock Market ETF. Some people prefer VOO for pure S&P 500 exposure, but I like VTI because it doesn't just focus on the mega caps. It also gives me exposure to companies earlier in their growth phase, before they become household names. A lot of today's giants didn't start at the top of the index. Now, quick practical note here, because this is where a lot of Canadians quietly lose money. Buying VTI means you need US dollars. And no, I don't just convert CAD to USD using my bank's default exchange rate. That's one of the most expensive ways to do it. I personally use Norbert's Gambit to handle the currency conversion more efficiently. Same ETF, same exposure, but way less money leaking out through FX fees. That way, I don't have to guess which company will be next. I just own the whole market and let the winners naturally grow into a bigger part of my portfolio over time. That 60% is what I call my sleep well at night money. Market goes up, cool. Market goes down, whatever. I'm holding it for the long run anyway. Next, about 20% of my portfolio stays in Canadian broad market ETFs. And no, this isn't me contradicting myself or suddenly falling back in love with Canadian stocks. This is about structure, not performance. As a Canadian investor, my life is still priced in Canadian dollars. My rent, my groceries, my taxes, all CAD. So having some assets that naturally match that currency just makes my financial life smoother, especially later when I actually start spending this money. On top of that, Canada still plays a role from a tax perspective. Canadian dividends get favorable treatment in non-registered accounts, and ignoring that is just leaving free efficiency on the table. I usually use VCN or XIC depending on the account. This gives me exposure to the banks, railways, telecoms, the boring cash flow heavy stuff. I don't expect this part to be the growth engine of my portfolio. That's not its job. Its job is stability, income, and making the overall system work better. It's not exciting, but it earns its keep. Here's where people usually misunderstand my tech exposure. I'm not overweight tech because it's exciting or because AI is a cool story. I'm overweight selectively, and that distinction matters a lot in this market. Right now, tech is not one trade. It's split into winners that are actually delivering earnings and cash flow, and everything else that's just riding the label. When I hold stuff, the QQQ or VGT, what I'm really betting on is earnings durability, not hype. These companies are already dominant, already profitable, and they have pricing power even in a higher rate environment. And yeah, valuations are not cheap. I'm fully aware of that. That's why this isn't a blind bet. This part of my portfolio gets watched more closely. If rates spike hard or earnings start to crack, I'm not married to this exposure. I trim, I rebalance, I manage size. The reason I'm still overweight is simple. When growth slows, capital doesn't scatter evenly. It concentrates into businesses that can still grow without relying on cheap money. That's been big tech, not speculative tech. So I'm comfortable carrying that risk, not because tech is the future, but because structurally, this is still where money hides when it wants growth with balance sheets. And then I save 5% for what I call my wildcard plays. This is my fun money where I can scratch that trading itch without blowing up my whole portfolio. Sometimes I'm in sector ETFs like semiconductors with SOXX. Sometimes I'm in thematic plays like clean energy or cybersecurity. Sometimes I even mess around with leveraged ETFs, but only with this 5%, never with my core holdings. This keeps investing interesting for me and stops me from doing something stupid with my main positions when I get bored. Now you might be wondering, Alex, why this specific breakdown? Why not 50-50 or 70-30 or whatever? And here's my thinking. The 60% US total market gives me solid exposure to the world's biggest economy where most of the innovation is happening. The 20% Canadian keeps me grounded and covers my home currency needs. The 15% tech lets me be aggressive on the sector I believe in most. And the 5% wildcard lets me experiment and learn without risking everything. It's aggressive enough that I can actually build wealth, but balanced enough that I'm not going to panic sell when the market drops 20%. All right, now let's talk about the part that actually makes or breaks your returns. And most people completely ignore this. Taxes. Oh man, taxes on US investments as a Canadian can absolutely wreck you if you don't know what you're doing. So listen up, because this section alone could save you thousands of dollars every single year. When you own US stocks or US listed ETFs as a Canadian, the IRS withholds 15% of your dividends right at the source. You don't approve it and you don't see it. It's just taken before the money hits your account. Now, here's where people get confused. Whether that money is actually gone depends entirely on which account you're using. If you're holding US ETFs inside a TFSA, FHSA, or RRSP, that 15% withholding tax is truly gone. You can't claim it back. You can't offset it. There's no workaround. It's a permanent leak in your returns year after year. But if you hold US stocks or ETFs in a non-registered account, it's a different story. That withholding tax can usually be recovered through the foreign tax credit when you file your Canadian taxes. So you're not getting double taxed. Still annoying, still messy, but not lost forever. Now here's the part that actually changed how I structure my portfolio. If you had US listed ETFs inside an RRSP, that 15% withholding tax doesn't apply at all. Zero. This comes straight from the Canada-US tax treaty, which specifically exempts RRSPs. So instead of figuring out credits or losing money quietly, the dividend just comes to you in full. Same investment, same yield, same market risk, but structurally way more efficient. That's not some aggressive strategy or a clever trade. That's just putting the right assets in the right account and letting math do its thing over time. But here's the thing. Knowing which ETF to buy and which account to put it in is only half the game. Most people mess this up at the execution level. When to contribute, how to automate it, how to rebalance without overtrading, and how to actually stick to the plan when the market gets ugly. So in part 2, I'm going to walk you through exactly how I execute this, step by step in real life, the systems I use, the mistakes I made early on, and how I stopped emotion from wrecking my returns. This channel is all about helping Canadians build wealth in US markets without getting crushed by taxes or making rookie mistakes. So subscribe if you want to stay ahead instead of reacting late. Now go set up those automatic contributions and start building that portfolio. Let's get this money. I'll catch you guys in the next video. Peace. In the end, this video is for information and sharing purposes only, not financial or investment advice. Always do your own due diligence.